Imagine waking up to the headlines that the stock market, after reaching record highs just earlier this week, is suddenly tumbling for a third straight day. The optimism that filled Wall Street on Monday now feels distant, replaced by nervous chatter on trading floors, glowing red numbers on monitors, and analysts trying to explain what went wrong. Investors are asking the same question you might be asking right now. Is this just a temporary dip, or the first crack in the foundation of an overheated economy? Tonight, we're diving deep into what happened Thursday on Wall Street, why certain stocks are at the center of attention, and what the latest signals from the economy and the Federal Reserve could mean for you. When the opening bell rang on Thursday morning, the mood was already cautious. Traders whispered about whether the market could really sustain the record highs it had touched earlier in the week. By mid-morning, the screens were glowing red. Oracle stock was one of the first big names to tumble, and it wasn't just a routine dip. The company had just issued bonds to raise money for its massive artificial intelligence build-out. Normally, financing innovation might sound like a positive step, but Wall Street didn't see it that way. The bond sale raised concerns about whether Oracle might be overextending itself financially in the chase to stay competitive in the AI race. One trader on the floor reportedly muttered to a colleague, "AI is the future, but debt is the present problem." The selling pressure reflected that uneasy balance, hope for growth clashing with the fear of risk. Micron, another tech name often tied to the AI boom, also stumbled. Its shares declined, sending ripples through the semiconductor sector. Micron has been seen as a bellwether for demand in chips, especially memory chips, which are critical for everything from smartphones to cloud computing. Its weakness raised questions. If Micron is struggling, does that mean AI demand isn't as bulletproof as some thought? Or is it simply a matter of timing, with profits yet to catch up to the hype? Investors debated, but in the meantime they sold. But the tremors weren't confined to technology. In the real economy, a disappointing quarterly report from CarMax sent shockwaves. The used car giant reported a poor quarter, and its shares tumbled sharply. For many analysts, this was more than just a bad earnings result. CarMax is often considered a barometer for consumer health. If Americans are pulling back on buying cars, even used ones, that raises real concerns about the broader economy. A portfolio manager on CNBC tried to downplay the news, saying, "Car sales can be cyclical," but others weren't convinced. On social media, investors pointed to CarMax's slump as a potential canary in the coal mine, a sign that high interest rates and tighter consumer wallets are starting to bite. By mid-morning, all three major indexes, the Dow Jones, the S&P 500, and the Nasdaq, were edging lower. If the losses held, it would mark the first time since March that all three had fallen for 3 consecutive days. And the timing wasn't lost on anyone. This stretch of weakness came just as the country was entering the run-up to President Trump's so-called Liberation Day, an event that has carried both political and economic symbolism. For some investors, the coincidence felt ominous. For others, it was merely noise. Still, the pressure was visible. Traders biting their lips, phones pressed to ears, and the anxious hum of a market unsure of its next move. Interestingly, around 10 a.m., the mood shifted slightly. The indexes paired their losses, showing resilience. Maybe it was bargain hunters stepping in, maybe it was algo-driven buying, or maybe just a pause in the selling frenzy. But as quickly as the rebound appeared, it left traders scratching their heads. Would the declines hold through the close? Or was the market about to stage one of those intraday reversals that leaves everyone surprised? Nobody knew for sure, and the uncertainty kept the tension high. On the economic front, Thursday also brought a flood of data. The final estimate of second quarter GDP growth came in stronger than expected, 3.8% growth versus the earlier estimate of 3.3%. That's a significant upward revision, suggesting that the economy is expanding faster than analysts had believed just weeks ago. For investors, the number was a double-edged sword. Stronger growth means more resilience in the economy, more profits for companies, and more optimism for the future. But it also means the Federal Reserve could feel more confident about keeping interest rates higher for longer. And higher rates, of course, weigh on stocks. Adding to the mix, the weekly jobless claims report showed fewer Americans filing for unemployment benefits. On the surface, that's good news. It suggests that the job market remains solid, and that layoffs aren't spiking. But once again, for Wall Street, good news isn't always good. A resilient labor market gives the Fed even less reason to cut rates anytime soon. And with inflation still hovering above target, the central bank has every incentive to stay vigilant. Meanwhile, monthly durable goods orders surprised to the upside, thanks in large part to a surge in aircraft orders. Boeing's name popped up as a contributor to the bounce. That's another sign of economic resilience, but once again, one that complicates the Fed's balancing act. Too much strength could risk reigniting inflation pressures. As bond traders digested all this news, yields climbed. The 10-year Treasury yield hit 4.19%, reflecting both the strength in the data and the uncertainty about Fed policy. Rising yields usually pressure stocks, and Thursday was no exception. For investors with long memories, the move brought back echoes of last year, when surging bond yields repeatedly pulled the rug out from under equities. Still, not everything was bleak. In the S&P 500, Intel was a standout performer. The stock soared 7% after a report surfaced that the chipmaker had approached Apple about an investment. That kind of headline can electrify a stock, and Intel's surge provided at least a glimmer of optimism in an otherwise gloomy day. One trader remarked, "When you've got Apple's name in your story, the market listens." Beyond equities and bonds, the commodities market also had its share of drama. Platinum prices notched a new high for the year, climbing to levels not seen since 2013. Up 67% for 2025, Platinum's surge reflected a mix of industrial demand and investor interest in alternative stores of value. For some, it was a reminder that while the stock market may be shaky, other assets are enjoying a bull run of their own. As the day unfolded, eyes turned toward the Federal Reserve. Two key Fed governors, Michelle Bowman and Michael Barr, were scheduled to speak. Their comments, though not yet delivered, loomed over the market like storm clouds. Investors wanted any clue about the Fed's next move, especially ahead of Friday's release of the central bank's favored inflation gauge, the Personal Consumption Expenditures Price Index. Would the Fed signal patience, or would it lean hawkish? Every word from Bowman or Barr could send ripples through markets already on edge. Inside trading desks across New York, conversations kept circling back to the same themes. "Are we overreacting to CarMax?" one analyst asked aloud. Another shook his head. "It's not just CarMax. It's Oracle, it's Micron, it's yields. Put it all together, and it's not a great picture." In coffee shops near Wall Street, the chatter was more casual but no less concerned. Retail investors debated whether to sell, hold, or buy the dip. One young investor scrolling on his phone muttered, "Every time I buy, it drops more. Maybe I should just stay out until the Fed speaks." By late afternoon, the market remained tense, the indexes hovering in negative territory. The question wasn't just about Thursday anymore, it was about the narrative forming. Would this three-day slide mark the start of a deeper correction, or would it be remembered as a minor stumble on the way to new highs? The answer depended on data, on Fed policy, on corporate earnings, and perhaps most of all, on investor psychology. So, what can you take away from a day like this? The stock market is never about one single headline. It's about how dozens of moving pieces interact, corporate decisions like Oracle's bond sale, earnings disappointments like CarMax's, macroeconomic numbers like GDP and jobless claims, and policy expectations surrounding the federal. On Thursday, all those threads tangled together, creating a picture of uncertainty. For some, that's frightening. For others, it's opportunity. And as the closing bell approached, one thing was clear. The story of this market is still being written. Whether the slide continues or the rally resumes, Thursday reminded everyone of a simple truth. Records can inspire confidence, but corrections can arrive quickly, without warning. On Wall Street, fortunes shift in the blink of an eye, and the only certainty is that the ride never stays smooth for long.